All right. Welcome to what is probably going to be the last SEM University of the year. Thank you so much for joining us. I know we kind of got this notification out there a little late. We do apologize for that. Hopefully those who couldn't tune in live are able to listen to the replay. This was actually born out of my first in-person meetings in about 18 months. And over a course of a couple of days, I was able to meet with about 300 different individual clients. And we didn't do a prepared presentation. We just kind of spoke off the cuff, and a lot of the questions and issues that had come up during those sessions, we thought were so important that if that subset of clients was asking these questions, probably a lot of our clients and advisors were asking them. So that's the reason we wanted to get this done before Thanksgiving, just so that, maybe hopefully politics and the economy doesn't come up too often at your Thanksgiving celebrations. But if they do, we want to come and provide data to kind of get through all the noise that we're seeing out there. And I don't have a lot of time today to get into that and the whole political divides and things like that. I will have to touch on it, unfortunately. But before I get going too far, let me just remind people that I'm a registered independent. So as I told all the people during our client events, I will probably equally offend both sides. And in fact, during one of the sessions, I had a gentleman in the front row keeping track of who I was offending the most. And we ended up 5-5 by the end of the lunch. So that's not my intention. I think everybody's entitled to their own political beliefs, and I'm not intending to insult you. The reason I'm an independent is because I feel that there's good ideas from both sides and bad ideas from both sides, and I choose to just look at the data. And from an investment manager perspective, it just doesn't serve me or our firm or our clients to take a political stance. In fact, just about a year ago, we were talking about the way to look at the election, and regardless of the outcome, we just wanted to remind people to not let your political opinions influence your investment decisions. And here at SEM, we definitely follow that rule. One of the things I want to remind everybody of as we look at this, because everybody is human, which means everybody will experience some sort of emotions when it comes to dealing with the markets and their finances. And I put this quote up here because it's really my favorite quote to describe what happens in the market. And it's the simple fact that the market is the function of overreactions in both directions. And in fact, this is the actual emotions that psychologists have studied that each of us feels during different parts of the cycle. Now, all of us are going to feel them at different times. And what I love about this and the way SEM's investment management strategies work is the consensus of all the emotions turns into the prices you see in the stock market, as well as the volume behind those prices. And that turns into the way that we manage money. And what we saw happening in 2020, as COVID hit, we went from euphoria to panic. But then as things started to settle down a little bit, as Congress flooded the economy several different times with stimulus, as the Federal Reserve stepped in, we saw the markets overall flip right back to what I would call a euphoric stage. And we've kind of been in that for all of 2021. We've had a few speed bumps along the road, but from a stock market perspective, it has been very euphoric. And I'm not saying that's wrong, and I'm not saying that's bad. But what people have to keep in mind is over the long run, the stock market cannot exceed the growth rate of the economy. It all has to cycle back down. So either we need to see the economy support the euphoria we've been experiencing in the stock market, or the stock market's due for a pretty heavy correction. So while we're talking about the economy, I think what's important to understand is people are so focused on getting back to normal, but yet I don't think we fully realize that normal is probably never going to be the same. I hate the term new normal. I think that's overused, but it's going to be different. And so many people who are looking at it of how do we get back to normal are focusing just on getting back to the 2019 levels. And I put this chart up here of our GDP, so our economic output. And you could see through the end of last quarter, we're up about 1%, which all things considered is pretty dang good. Keep this other number in mind though, that big almost straight up arrow. The economy off the bottom has grown by 13%. That is unprecedented. Even coming out of World War II, we did not see that type of growth. Out of the Great Depression, we've never experienced that sharp of a growth rate in such a short amount of time. This has obviously created some weird things happening inside of our economy that we're going to talk about that we need to all understand as investors and voters and everything else. The thing that people are missing out on, first of all, though, is the fact that we dumped $5.3 trillion just in the name of stimulus. And maybe this offends both sides, maybe it doesn't, but we have to keep in mind 2/3 of that $5.3 trillion was signed by Donald Trump. The other 1/3 was signed by Joe Biden. This is a bipartisan stimulus, bipartisan decision to dump $5.3 trillion into our economy. And we're seeing that the impact of that is really strange. This chart up here looks at consumer spending. And I put a few dots in there. We're going to come back to talk about tax cuts expiring there. Even the Trump tax cuts, you could see the growth rate had actually dropped a little bit going into COVID, and we'd slowed down just a little bit because the benefit of those tax cuts had worn off. And then you see the sharp slowdown in spending and then the very sharp recovery. But if you go back and you draw the line from when things settled down after the Trump tax cuts, what you'll see there is we definitely have exceeded now the growth that rate that we had before. So this is not returning to normal. This is above normal if you consider 2019 your normal levels. And that obviously is creating some disconnects inside of the economy. The other thing, let's look at personal income. I think this is something that is not being fully appreciated in terms of the stock market. Now, disposable personal income is the money you have left over after paying taxes. And again, I added a few different data points here. Expiration of the tax cuts, it hurt personal income, but it didn't hurt spending overall. But what's really important to look at is this yellow line that I drew on there, because that is the long-term trend going back to where things normalized in 2015. So when President Obama was still in office, tax rates had normalized. We saw a temporary bump after the Trump tax cuts, but then it reverted back down to this longer-term trend line. If you look really closely there, personal income is now running below that trend. So while we dumped $5.3 trillion in our economy, and definitely we saw a lot of that money spent, the fact that it's slowing is something that I don't believe economists are looking at as far as what's going to happen in 2022. And that's going to become really important when we start talking about the outlook for inflation, because as personal income slows down, we're not getting that much more stimulus being sent. Yes, we still have some child tax credits. Congress is going to try to make those permanent rather than having them expire here at the end of the year. I don't know if they'll be able to do that or not, but that's just a small amount compared to the $5.3 trillion that was sent just since March 2020. Now, the other thing, this number fascinates me, and I didn't quite get the update from this week, but so far, consumer sentiment, how people feel, is worse than at any point during COVID. Let that sink in for a minute. Consumer outlook right now is worse than at any time during COVID. You see the peak there. June 2021 was kind of the peak of it. Remember, that's what after everything had shut down, they were reopening, vaccinations were in place. We've gone down pretty dang quick since then. And you can see where we were at in February. And I put some circles there because I talked about this before under the Trump presidency, was we did see a very nice rally, but overall, consumers don't come anywhere close to feeling as great as they did in the year 2000. So consumer sentiment has been kind of negative for a while. We need an excited consumer to keep spending money. Otherwise, this demand that we're seeing for things is going to start wearing off. And if I were to update this number now, we actually saw it drop even further so far in November. So it's getting worse and worse, which again is a concern I think that we should have as far as economic growth goes in 2022. Now let's talk about jobs and getting back to normal. I wanted to add some arrows here to these charts just to remind people that it takes a really long time to recover lost jobs. And it took 44 months. The Republicans, I believe, lost the election because everybody called this the jobless recovery under George W. Bush coming out of the 2001 recession. But then it took even longer under President Obama, 77 months to recover all the jobs that were lost during the great financial crisis. Now we're so far running about 97% of the February 2020 levels. But I think just trying to use this number and say, well, that's going to mark when we're back to normal. When we get back up here to the same number of jobs, if we can recover those quickly, then everything's going to be great. What people don't understand is every economic shock brings a new structure to the economy. And COVID overwhelmingly exposed a lot of the structural issues that I've been talking about for 20 years with our economy. And it's led to a lot of things. And we've heard a lot of narratives. One of the narratives that I've seen people make was, well, the reason we haven't seen the people come back to work is because they're getting unemployment benefits, the extended benefits that went on. Well, those all expired nationwide in September, but 22 states had already allowed them to expire in July. If you look at the continuing claims, so this is people on long-term unemployment, you could see how quickly this number has come down. And in fact, going into the month of November, we were all the way back to March 14th, 2020, as far as people on long-term unemployment. So that to me shows us that it's not just people sitting at home collecting unemployment. In fact, we have the same number of people collecting unemployment today that we're collecting it all the way back in 2014. So that to me is not the problem with the labor force. The real issue is we just have fewer workers. 3.1 million people net. So that's people coming in versus people leaving. We've seen a decline of 3.1 million people. At the same time, if you look at this chart on job openings, I drew the long-term trend there going all the way back to 2011. Look at all these job openings, way more than we ever had. At the same time, we've had the labor force decline by 3.1 million people. And I think what we're missing here is the things that COVID exposed really created a different labor force that we just can't ever assume we're going to get back to normal if you consider it to be normal what we had in 2019. So just since the beginning of 2020, we've seen 3.3 million baby boomers retire. In fact, we're seeing probably more than 3 million are going to retire in 2021, and economists expect even more than that in 2022. So we're talking about 10 million baby boomers in the 3-year period leaving the workforce and pulling that retirement cord. Not necessarily a bad thing, but it's a lot faster than people were expecting. We were running at a pace of 1 to 1.5 million baby boomers per year expected to retire over the next 3 years. So we've lost those workers. We've seen 3 million women tell the BLS, Bureau of Labor Statistics, that they have permanently left the workforce. Now let's think about this. For a lot of people, and I see this a lot of times when I do financial planning, that second income is typically going to pay for car loans, credit card debt, student loans, and usually childcare, preschool, daycare, whatever it is, as well as commuting expenses. So when I've helped people do a financial plan, and a lot of times their heart says, hey, I would like to have one of us home with the kids. The difference was the debt they had, childcare, commuting expenses. according to the Fed, 64% of the stimulus, that $5.3 trillion was spent. But that leaves 36% of the money was not spent. It was used to pay down debt or to go into savings accounts or investment accounts. I've seen countless people in our community who did not spend the money, but instead they used it to pay off their car loans, their credit card debt, their student loans. Now, all of a sudden, they don't need two incomes. And that's why 3 million women have left the workforce, because of the $5.3 trillion we've dumped on there. Another great benefit of the stimulus, and I never thought I would say this, because great, I think a lot of that $5.3 trillion is completely wasted. But I'm trying to look at the bright side here. According to Salesforce, 4.4 million small businesses were created in 2020. That is double the number we saw in 2019. I personally have witnessed 4 people that I've been helping do financial plans switch from being a W-2 worker who got laid off or had their hours cut during COVID. They took their stimulus money, they took their unemployment money, and all of a sudden that business that seemed way too risky when they had a full-time job suddenly became one of their best options. And they've shifted from being a W-2 employee to having a small business that is cash flowing enough that they don't ever need to go back to work for somebody else. Now, granted, not all small businesses are going to have that kind of success, but that's the type of thing that we saw, that American spirit prevailed, where they shifted from working for somebody else to working for themselves. 4.4 million people did that. That's people no longer in the labor force. And then finally, we saw this a lot in the Richmond, Virginia area and Tucson, Arizona, where we have offices. We also happen to have Amazon warehouses. 500,000 people in 2020 were hired by Amazon. So far, they've hired another 150,000 in 2021. The latest numbers from Walmart since the beginning of 2020 is they've hired 125,000 workers. Target was somewhere around 75,000 workers. So we've seen a lot of people who are working fast food, doing shift work at different restaurants, get better paying jobs at Amazon, Walmart, Target. And now they're just not there. They're not there to go to work. So it's a big structural change in the labor force that I believe means we're not going to get back to what we consider normal. Now let's shift a little bit to inflation. Now, let's talk about that. Remember, $5.3 trillion was dumped on the economy. That's 25% of GDP. So we dumped a quarter of our GDP into the economy. The Federal Reserve had another 4.4 trillion. So we saw almost half of our GDP go into the economy. And this chart here, it's a little noisy. I just want you to focus on the dark blue lines. That is the number of containers coming into the various US ports in 2021 versus 2019. And you can see, obviously, they're all higher, especially you look at Los Angeles and Long Beach, which is getting a lot of the press here. But more importantly, demand for real consumer goods is up 15% just in the last year. We're seeing unprecedented demand for consumer goods. It's just overwhelming our system. This was the long-term trend, and now we're running way above trend. The system was not set up to handle that. Now, let's talk about inflation. You know, it's something that nobody was ready to handle. But when you take a step back, you have to realize after a recession, inflation is normal. This is the long-term inflation indicator, and it's a better number than CPI. It's what the Federal Reserve actually uses. It's personal consumption expenditures. I can't get into all the details of why CPI is such a horrible gauge of inflation, but PCE is a much more accurate number, and you can see this long-term trend line. If you go back to 2019, we've seen inflation go up an annualized 2.1%. Nobody's writing headlines about that. You know, it's normal. This is normal. What we saw after the financial crisis was inflation ran above normal. And then we saw an economic slowdown, which I mentioned many times, led to the election of Donald Trump. And then we saw inflation accelerate back to the trend. It ran hot under Donald Trump, by the way. And I've pointed that out to people. It ran pretty hot for a while because the economy was growing. That's what people forget. We have inflation because the economy is growing. Now, granted, inflation is up 13% in a year, but only 2% over the last 2 years if you annualize it. That's important to understand. I'm of the camp, and as is the Federal Reserve right now, that we're probably going to be more worried about deflation than inflation a year from now. And a lot of people might think I'm crazy. Please don't log off of this call. Here's what I'm talking about. Deficits are by and large deflationary. Think of your own personal accounts. If you're using your credit cards to support your spending, when that credit card statement comes due, you're going to have to take more of your current income to pay back debts that have already been accumulated. And those debts, the more you run deficits, are going to eat up a bigger and bigger portion. That slows down your growth. Well, the same thing happens with our government. So I believe these huge deficits we're running are going to be deflationary and something we have to worry about. Too many retirees are deflationary. When you're producing, there's something called when you're working, there's a money multiplier because you're producing goods and services and that's being bought. And so the money multiplies. When you shift to a retiree, the money you have that you receive, whether it's from your pensions, your investments, or your Social Security, that's a money divisor because that's money that's not going to keep producing more and more money. So that's deflationary. And I mentioned 10 million baby boomers are planning on retiring. That's deflationary. Excess savings is deflationary. I love to see how people have fixed their budgets. Please fix your budgets. But as an economist, they call this the paradox of thrift. When too many people are saving, that slows down the economy and actually creates deflation. And we're seeing that. The savings rate is higher now than it's ever been in the last 20 years. That's a good thing personally, but a bad thing for the economy. And it's something that's going to cause some deflation. Increased productivity is deflationary. I'm doing this rather than having to fly around the country. I hope we always are able to do things like this. We threw it together in a couple of weeks. We invited y'all to come watch us. We're going to have probably 100 or so more people watch the replay. I'm not living in a hotel. I'm not sitting on an airplane. That's more productivity from me. And we're seeing that happen across the country. That is, in the end, deflationary, and we'll start to see that filtering through. Inventory surpluses are deflationary. We're seeing this, and I hate to admit it, but us as a family, our subscribe and save on Amazon, we started noticing some of our household supplies were being back ordered by 3 months and then 5 months. Well, we started stocking up. I think you're seeing a lot of people. You talk to car manufacturers or car dealers, retailers, everybody's buying as much as they can. They're forgetting that in 2022, we're not going to have all these stimulus checks. That means consumers are going to have less income, less to spend, and we're probably going to end up with a surplus of inventory that's going to have to be offloaded. That's deflationary. And finally, I just say this out of irony, but it's true. Inflation is deflationary because if prices go up too far, it's going to reach that breaking point, and then we're all going to decide, you know what, I don't need to buy it, and then prices will start to come back down. We're literally watching economics 101 happening right before our eyes. There will be a breaking point. Things like gasoline, that'll be the last thing to break, but things like computers, if they keep going up in prices, tablets, iPhones, whatever it is, they go up too much in price, people are going to stop spending money on them, and then we'll see prices come back down. That's just how it works. So now I want to shift gears and talk about a really hot button topic of infrastructure. We did see, finally, I believe it was signed on Monday, the bipartisan infrastructure bill was signed. I think what people forget is we need this infrastructure. Every president has wanted infrastructure. We're still spending money from President Obama's shovel-ready projects from the American Recovery Act. It's a good thing to invest in infrastructure. But the thing that most people miss out on is the only way mathematically to grow our economy is two things. You increase your workforce or you make them more productive. In fact, the economic equation is very simple. Productivity growth plus labor force growth equals GDP growth. That's it. Hopefully it can become a multiplier, because if productivity actually starts increasing more, then you start to have more. But I put this chart up here on the screen to illustrate a few things. First of all, you see what's been happening to our labor force. It's declining. I showed you the chart from 2020. We're going to lose 10 million baby boomers. We're losing workers quickly. We need more people working. But at the same time, productivity has not grown by that much. It's grown and annualized about 2%, going back to the 1990s. You would think with all these innovations that we would have higher productivity, but we don't. The combination of those is the green line, but we haven't been hitting the potential GDP, and that's because of our deficits, both the trade deficit and our budget deficits, because some of that productivity and some of that labor force income has to go back to paying our debts. It's going to our trade deficit. So that becomes an issue. But what I do love about the ideas I've seen, and some of the ideas I've seen, this is not an endorsement of the whole plan of the Biden agenda, is they're looking at what's called soft infrastructure. They're looking at more, how do we make people more productive? How do we get more people working? So the child tax credit, if that gets more people to go to work, that's a good thing, because that helps grow it. That's an investment. Now, if we just give it to somebody in the name of health insurance or things like that, that doesn't make more people go to work, and that doesn't make them more productive. Therefore, that's spending that has to be paid back later. That's just how economics work. So we should be asking ourselves, with every item in every bill, does it increase our workforce, or does it make them more productive? Preferably, I'd like to see it do both. If it doesn't, that's spending, and that's a waste of money. If it does, that's an investment in our future, and will hopefully grow GDP and pay for itself. Unfortunately, everybody is focusing so much on how do we pay for it. And I'm not going to get into the details. I just want people right now to not freak out about taxes going up, because I looked in our database, and we have maybe 8 clients who are going to be impacted by so far the proposed Biden tax increases to pay for the bill that hasn't even made it to a vote on the House floor. So what I want people to keep in mind is, I go back to the expiration of the 2001 and 2003 Bush tax cuts, where they let the top 2 brackets go back to where they were at in 2001 before Bush pushed those through. We saw no change in consumer spending. But you go all the way back to Bill Clinton's tax hikes, where the top 4 brackets went up. We saw no change in consumer spending. He actually did a good thing that I don't know if enough people are aware of. The Clinton small business tax cuts. Again, all these different tax changes didn't really change the trajectory of consumer spending. So I think that's a lot of noise about nothing. But there are certain people whose taxes may go up, and that's why you have a financial planner. And it's definitely worth talking to somebody if you feel you need a second look at your tax situation. Now, briefly, I just want to talk about politics. I said I was offending both sides. What I want to do today, my number one goal, is to have, regardless of your political affiliation, have you not freak out about what's happening right now. Because people forget, the election was not a mandate for progressive policies. Joe Biden was the least liberal Democrat in the whole primary. He ended up surviving all of them. If you then look at the overall voters in the general election, back in 2020, 40% of voters were registered independents, and 31% were Democrats, 29% were Republican. Since then, we've actually seen the Democrats lose a couple percent, 2 more percent independents. Independents control the votes. Moderates control the votes. That is key. Yes, you get a lot of noise from the 50.1% majority from both sides, but independents control the votes. And we saw that happening in the Virginia elections just a few weeks back. And I believe that's where we're going. We don't need to freak out about politics. Please, 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 number one rule of investing, don't let your political beliefs influence your investment decisions. And I say that because independents, the moderates, are controlling the vote. If it starts swinging too far to one side, they switch it back over. And that becomes very, very important to understand. So now let's quickly close with looking at the stock market. And I like to show this chart because if you look at the stock market since 2009, every dip should be bought. Even the worst of 2020, hindsight says we should buy the dip. What I remind people of, the stock market is a mean reverting mechanism. And what I mean by that is anytime we've seen tremendous growth, 16% annualized returns during the tech bubble, 15% housing bubble, we're looking at 15% annualized return in what I'm calling the liquidity bubble since 2009, it always reverts back to the mean. The stock market mathematically cannot be worth more than the economy. That is something we have to understand when we look at that. Finally, what should we expect in terms of returns? I am not going to go into the details of all of these charts, but several large firms are saying we need to lower our expectations for the future. You look at Morningstar, they're very dire. The next 10 years, they're saying stock returns annualized could be negative. And the reason they're saying that is because valuations are so high. When you buy at very high valuations, your future returns are lower. This typical 60-40 portfolio, if you're buying and holding, Morningstar is saying you should only expect 0.5% return. Vanguard, everybody's heard of Vanguard, right? They're saying a 3.8% for that 60-40 portfolio and 3% expected return for stocks over 10 years. Let's talk to BlackRock. This core stock model is something we put together for our clients using iShares. And then the core bond, they're saying stocks, they're the most optimistic, 5%. That's about half the long-term average. Bonds, they're saying only about 1.6%. When you put it all together in that 60-40 portfolio, they're saying 3.8% expected returns over 10 years. Now, I'm not trying to be a downer as we go into Thanksgiving. What I'm wanting to remind you of is what we've had the last 10, 12 years, especially the last 12 months, is not normal. We're shifting, our economy's shifting. In the end, that's going to be a very good thing, but it could be a very painful thing. We put together our behavioral portfolio approach that is designed as a pyramid because every piece works together. The most important thing is we work off the financial plan, we work off the cash flow strategy, and then we design portfolios that can navigate that. Inside of your plan are some expected returns. Your advisors, or if you're an advisor working with SEM, you communicate that to us, and we can customize portfolios across all kinds of different asset classes. Now, remember, those returns are passive portfolios. That's this dotted line here. Historically, especially for those conservative to moderate to even the growth type investors, SEM has generated returns that are much higher than the long-term average buy and hold. So pessimistically, Morningstar saying 0.5%, BlackRock optimistically saying 3.8% for that 60-40 portfolio. The reason SEM does what we do, the reason we stick to only the data is we look for opportunities where everybody is freaking out and selling. And then we also look at times where things start to get a little bit iffy. Going into the end of the year, as of right now, we're fully invested in pretty much everything, but there's a lot of warning signs flashing. November and December tends to be one of the best times for the market. Hopefully it is again. There's nothing yet looming that could change that. But if there is, we're ready to act. We're literally in our tactical bond, cornerstone bond, these low risk models, we're literally a couple times a week within one more down day of selling. That's how quick that trigger can be on the conservative stuff. The growth stuff, we're going to let it go a little bit longer. But more importantly, 2022 could be a really different year. And I want you to be prepared. So please use our website. We have a lot of resources there. Our risk questionnaire, you can take that. You can ask to speak to your advisor. It'll generate SEM to review your account. Check out the Traders blog. That's where we put a lot of this information at least once a week. If there's videos we need to put out, we'll put them out there on the blog. So I know I went 5 minutes over what we had planned. So if you did plan on heading back out, definitely feel free to drop out. I am going to have maybe 3-4 minutes for questions. So with that, let me go ahead, and we had people submit some questions ahead of time. If you look at your Zoom meeting, down at the bottom of the screen, or depending on your screen, the top, there's a Q&A button, so you could definitely put those in the chat. So let me go ahead, and I'll look at some of the prepared questions while anybody else goes and enters the chat if they have some questions there. First one that was submitted said, I remember the 70s and this feels a lot like it. What if this turns out to be just like the 70s? And, you know, I think I won't date myself, but I will say that I remember the very end of those high inflation times. And I remember how much stuff cost. I remember what my first economics professors told me to expect for inflation. And that number was 7%. Since that time, we drifted all the way down to averaging 2% over the last 20 years. So, you know, I could see the fear. I understand. I think I'm not going to speculate. What we do at SEM is we follow the trends and we follow things. And there's investments out there that can make money in an inflationary environment, and they're in our toolkit, and we will use them if necessary. People forget the end of the 1970s, small cap stocks went through the roof because small cap stocks can do good in an inflationary environment. So that's something that we're definitely looking at. If it doesn't cool down in the early parts of 2022, like our models are suggesting they are, we'll probably do another webinar about how to invest in an inflationary environment. But like I said, so far, this seems to be temporary. And remember, even when it comes to gas prices, they tend to go up and down based on economic growth, not who's sitting in the White House. And that's something I remind people of. They went up under George Bush, they went down under George Bush. They went up under President Obama, they went down under President Obama. They went up a lot for a while under President Trump, and then they went down a lot. And they've gone up so far a lot under President Biden. Every time they've gone up is because we've had some strong economic demand. As that demand wanes, prices come back down. So hopefully that answered that question. Next one, also about inflation. Is all of this planned spending going to cause more inflation? So the bill that was just signed this week by President Biden could take a long time. Goldman Sachs is saying they only expect it to add maybe 0.5% to GDP growth over the next few years, and then that's going to dwindle down even more because it takes a long time to spend infrastructure money. They don't see that. I'm not even going to comment on the other half of the Build Back Better because, again, the moderates in Congress are tending to water down things. Because they understand independents and moderates voted for them. And if they go way too far to the left, they're probably not going to win re-election. So my answer is we've seen most of the spending. And like I said, our models are saying that we should be more concerned that we're not going to have extra spending from an economic perspective, which I think is going to cause inflation. So the other question was related to gas prices, and I already touched on that briefly. I'll do one more question in the chat. It says, from a market standpoint, how much of a correction will you expect from Congress trying to maintain seats going into next year's midterm elections and likely trying to win votes? That's a good one. I just did a webinar with a group of clients in South Carolina, and somebody said, the one given is Congress will do the wrong thing most often. If it means winning more votes. And so that is a good point to the risks of 2022. We're going to see a lot of posturing for re-election. And I don't know, the Democrats really, had a wake-up call here in Virginia, a state that, when I first moved here, I said, well, I guess, I lived for the last time under a Republican legislature. And 2022, we're going to have a Republican governor and Republican legislature. So that was the independents in Virginia speaking up. And I don't know how the Democrats are going to react. I don't know what the Republicans are going to do. But in general, this grandstanding, I think will probably hurt the markets, but not a lot. I think the bigger concern is what happens with the economy. And like I said, our models are showing that we need to be really concerned with the 2022 economy, less concerned with inflation, really concerned that valuations are so high, and just be ready. And like I said, check out semwealth.com, use our risk questionnaire, read the blog. There's a comment section, there's a contact us section. We're here for you. Our number one goal, whether you're a client or an advisor, is to let you do what hopefully you're going to do next week. Enjoy time with family, enjoy the things you like to do. Let us worry about the numbers. Let us watch the news. Let us try to dissect all that. Let us make the adjustments to the portfolios. Let you do what's important to you. We've been doing this. Next year's our 30-year anniversary. We don't plan on going anywhere. We plan on just applying this independent, data-driven approach to everything we do. So thank you for your time. Happy Thanksgiving to everybody. And if I don't see you, have a very Merry Christmas.